Good morning, everyone. I am Devesh Jain, and I welcome you all to this CEP webinar, which is based on practical use of rental approach in valuations. Okay, so in this webinar, we'll be talking about the rental approach, the income approach that we use to find out the rate of return and how we can find out the market value of the property based on the market rents that are available to us. Okay. So we'll just start with the session. So the first topic that we'll talk about, we'll just revise some of our concepts in 5 to 7 minutes, and then we can go with the case study. So basically, rental approach comes under the topic of income approach. Okay, income approach is one of the 3 primary approaches and provides an indication of value by converting the future benefits to a single current value. Yes. In income approach, as all of us know, that income approach is an indication of it converts the future benefits to the single current value, to the present value. The value of an asset under this approach is determined by reference to value of income, cash flows, cost of savings. So basically, income approach operates on the principle of net annual income that is generated by the property. Okay, income approach is based on economic principle of anticipation of future benefits, right? So what are the future benefits or the economic benefits that the property will fetch us? On that, the income approach is based on. Okay, and income approach is used to income generating or investment properties. So sometimes we don't use those properties, but those are income generating properties for us, right? Investment properties. So we generate economic benefits out of those properties. So to value such properties, the concept of income approach is used. So income approach is generally used where the income producing ability of the asset is critical element. So where the income producing ability of the asset is taken into account, where we do not know the market conditions, at this point, income approach is the most helpful to us. And there are reasonable projections of the amount and timing of future income which are available, where there are few market comparables. So in case where market approach cannot be used, or there are a very few market comparables or no comparables, then at such a time we use the concept of income approach, where we consider the rent, the outgoings, we find out the gross rent, we subtract the outgoings from the gross rent to get the net rent, and then we capitalize the net rent to find out the market value of such properties. Okay, so there are 2 methods of valuation which come under the principle of income approach, which are rental approach or income capitalization and discounted cash flow. Okay, so both these methods help us find out the market value of the property through rents. So we'll talk about rental approach or income capitalization first. In this method, the net yearly income which is generated from the property is considered. Okay, so what are the economic benefits, or what is the net yearly income that the property generates for us? That income is first considered. The expected income during a specific period for the property is divided by the expected capitalization rate. So we all know the concept of year's purchase, right? So year's purchase is the purchasing power of the buyer who takes the property, and that rate is used to find out the market value of the property. The income considered is the net income and net of operating and fixed expenses. So when gross income is calculated, all these outgoings are subtracted from the gross income, the fixed expenses, the operating expenses, and after which we get the net annual income of the property. So value of the property is net operating income into year's purchase, where year's purchase is found out by dividing rate of interest by 100. Okay, so it is 100 upon R, where R is known as the remunerative rate of interest. So what is year's purchase? So year's purchase is a factor by which the net income is multiplied to arrive at the capital value, right? Which is known as the year's purchase. It is the present value of ₹1 that we calculate per year for n number of years at a certain rate of interest. So that is why year's purchase factor is an important factor. As income approach talks about the anticipation of the benefits, the property will fetch in the future, YP is required. So YP is a very important factor that is used to calculate the market value of the property, right? So it is the purchasing power of the buyer. Now, next we talk about discounted cash flow method. Okay, so this method is also a very important method, right? So in this method, all the future cash flows are discounted by appropriate discount rate to their present value. Now, all of us know the concept of reversionary value, right? So in this, the future inflows are considered, like what inflow will the property generate in the coming future. So such projections are made, and all those future cash flows are brought to the present value today, are discounted to their present value as on today. The sum of all these present values for future cash flows for some specific years represents the value of the asset as on today. The cash flows discounted represent the free cash flows of particular periods and net of all outgoings. So these cash flows are net profit that is generated by the property during the year. Okay. So formula for discounted cash flow is CF, that is cash flow upon 1 plus R raised to T or N. So 1 upon 1 plus R raised to N is the formula for present value, and this is divided by the cash flow to get the present value of the cash flow. So CFT is cash flow in period T, R is appropriate rate of interest, and T is life of the asset which is to be valued. Okay. Now, there are two types of property interest that we value, right? So the two types of interest are freehold interest and leasehold interest. Okay. So first, what are freehold interest? So freehold interest implies absolute ownership of the property. When any person is the absolute owner of the property, right? He holds the legal framework and he can do anything with the property. Like he can develop it, he can transfer it, or he can generate economic benefits out of it. He can generate money out of it, right? By giving it on rent, lease. So all these are the benefits of the freeholder. Such an owner has the right to use the property for his needs, or to rent or lease or derive income from it by transferring the right of occupation to somebody else. So freeholder is the whole sole owner of the property legally and technically, right? So these rights are the freehold interests. Next, we talk about leasehold interests in the property, right? Any person occupying the property by paying a lease rent to the freeholder creates a right of occupation. Okay. So the property gets locked during the lease period. The freeholder cannot sell or do anything with the property. So such properties are known as leasehold properties, where the freeholder is called the lessor and the occupier is called the lessee. The valuation of lessee's interest in properties is called valuation of leasehold interest. So these are all just, it is just a revision, okay, so that we can move on to the case study. So these are just basic concepts under rent capitalization method or income approach method. Next is the type of rents. Okay, so these are some basic type of rents that we'll be discussing: ground rent, head rent, nominal rent, actual rent, market rent, profit rent, virtual rent, and monopoly rent. Okay, so these are some basic types of rents. Now those rents which we will be needing during the case study. So those are ground rent. So basically, what is ground rent? The rent charged by the landowner or the lessor to the tenant for the use of land under specified terms and conditions, right? So that is known as the ground rent. So that can be monthly, quarterly, half yearly, or yearly, right? So the ground rent may be the same for the entire rental or lease period, or it may be reviewed at fixed intervals. Okay. So rent can be the same for the total period, or it can be renewed every year or at fixed intervals. Second is the rack rent. So basically rack rent is the rent of the property, right? It is the full actual rental value that is generated from the property. So it can be only land or land along with the building. Okay, so rack rent is basically the market rent. All inclusive rent is known as the rack rent. Next we talk about is the gross rent of the property. So this refers to the amount received periodically. So in this gross rent, so it can be calculated per month also, per year also, right? From the landlord, from the tenant, which is inclusive of all the outgoings. So outgoings need to be deducted from the gross rent to arrive at the net rent figure. right? So what are the I would like to ask all of you, what are the various outgoings that are generated from the property? What are the various outgoings? I guess all of you can unmute yourself. Yes, property tax, taxes, maintenance, great. Management fees, correct. Repairing costs, absolutely correct. Correct. So these are the outgoings. Next is the head rent. Okay. Now, whenever as a freeholder, somebody gives their property on rent and there is a clause of sublease. Okay. So the lessee can sublease the property and then he can collect a rent which is higher than the main rent. And then he can give the head rent to the lessor and keep the difference with him, which is known as the profit rent. Okay. So the main lessee is called the head lessee and subleases the property to another person called the sub lessee. Head rent is the rent paid by the head lessee to the freeholder, correct? And the term head rent is used to distinguish this rent from the rent paid by the sub lessee to the head lessee. So it's a very simple concept, okay? Profit rent, it is the difference between the market rent and the rent paid by the sub lessee. So that's called the profit rent, which the lessee keeps for himself. When the profit rent exists, the occupier saves on his annual expenditure as the annual rent payment is less than the full rental value. Yes, so there are a lot of savings when profit rent is taken into account. Okay. Contractual rent. So contractual rent is the rent which is mutually agreed between the landlord and the tenant under tenancy contract, right? The rent may be for the use of land or land along with the building. Okay. The rent may not include taxes and outgoings, may or may not. So that depends totally on the person giving the property on lease and the person taking the property on the lease. So this contract includes agreed terms and conditions as to what can be done on the property, what cannot be done on the property, what is the tenure of the lease or the rent and such things, legal terms. Standard rent. So standard rent is the rent payable by the tenant to the landlord as per the norms fixed under the Rent Control Act. Okay. It can be defined as the rent fixed by the court for the property according to the provisions of the Rent Control Act. But Rent Control Act is not applicable everywhere, right? So presently in India, Rent Control Act is applicable only for such properties where the monthly rent is less than a certain stipulated amount. So there are certain conditions which are given in the Rent Act. Okay. And if the monthly rent is less than, I guess it is 3,500 or 4,000 rupees, I'm not sure. So if it is less than that, then only Rent Control Act is applicable to such properties. Virtual rent. So what is virtual rent? Whenever somebody gives the property, he takes a deposit from the person, right? So if the deposit is kept in the bank account, that will receive some interest. So the deposit plus the interest is known as the virtual rent. It is the sum of actual rent paid by the lessee and the annual equivalent. Annual equivalent is the interest received on the money kept in the bank. Annual equivalent of the premium paid to the lessor. Now we come on outgoings. Okay. So as all of you said, what are the outgoings? The income capitalized for estimation of value of net operating income. It is arrived by deducting the following expenses from the gross income, right? So these are the basic outgoings that we consider. So repairs, municipal taxes, insurance, and management fees. So these are the basic outgoings that we study, right? So we'll just look at them from just two lines. Okay. So repairs. The income receivable from the property is greatly dependent on its state of repair or the age of building, right? So what is the age of the building? What are the repairs that needs to be done? What are the regular repairs that needs to be done, right? So there are two types of repairs, basically regular repairing repairs or operating expenses of the building. And second is the capital expenditure. Now, what is the capital expenditure? It is the amount which needs to be spent from time to time to bring the property to a condition which is well maintained, and it's expected well maintained, and it is the capital to match the level of income which is being generated from the property. Okay, so if I give my property on rent, it is my duty to maintain or take maintenance from the person who has taken the property on rent, and to maintain the property so that next time when I give the property on rent, my level of income is not hampered. Okay, next is municipal taxes. So these are the rates levied by the local authority, like property tax, right? The actual amount paid as taxes forms an important component of outgoings. And such taxes are normally paid on a yearly basis. So normally municipal taxes are paid on a yearly basis or half yearly basis. And last is insurance. Yearly insurance payments are normally under fire insurance policies to safeguard against accidental loss to the property, right? The amount of insurance payment also depends on type of insurance policy booked by the owner. And similarly, the premium would be them. So usually such payments are quite small. Okay. And the last one is management fees. Management fees are the expenses incurred to manage or invest in the property. These include expenses incurred towards collection of rent, inspection of properties, and any defect which is therein to repair all those. These charges share expenses towards maintenance of common areas, lifts, lightings. If there is a garden, then maintenance of the garden, swimming pool, and all those.